Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, September 6, 2016. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. A lot of stuff going on. Welcome back from the long weekend. Let's get back into the action. I've got some updated numbers on the chart. You'll notice right away you'll see upside possibilities down here, 222.04, 223.95. We'll get into the specifics of those numbers in a couple of minutes, but let's just review the action today. It was an important close today, and I want to make sure that everybody's aware that what happened over the last 6 to 8 weeks in the month of July, in the month of August, is not likely to happen again in the month of September. September will prove to be very, very different in terms of A, the market going sideways, that's not going to continue, and B, in terms of volatility. Now, if the market goes higher, volatility gets sucked downward, but if the market goes down, volatility inflates or increases. So we had another light volume day today. There was about 50 million shares traded in the SPY. That's a light volume day. Basically, you can say after a day like this that nothing happened. It was like a hangover from the long weekend. That's fine. But in reality, today's close was extremely, extremely important, and I can't emphasize that enough. So let's drill down a little bit. I'm going to flip over to the hourly chart. And let's take a look at what we've got. So on the hourly chart, the first candle of the day is here, this red candle. That was a down move. The market made one down move today and then was up the remainder of the day, more like a trend day higher from that first candle of the day. But what's important is the close. Now, we haven't seen this number for a while. It's been on the chart for a while, 218.91. We haven't seen or talked about it in a while because the market's been in a different zone. It's been down at lower levels. But now that we got back to this number, and we almost touched it the other day on the 2nd of September, and what that number represents to me, based on my work, and I reconfirmed, double confirmed, and triple confirmed all my findings over the weekend. And what I want to make sure that everybody's aware of is the 218.91 is so important. The fact that we closed above that number today, and you know what? It's interesting because you'll see the magic hand. If I go down to the 10-minute chart, look at the magic hand of the market. In the last 10-minute candle of the day comes to the window with 4 million plus shares, and it was just a persistently up candle to close above the 218.91. What you'll also notice is when we talk about patterns, and here's what's important, if you look at a 10-minute chart, you had an up move, okay, we went sideways, and then the last candle of the day, we finished that pattern to the upside. So that's not a surprise when we just talk about the patterns and what the result was from that pattern. However, let's talk about the importance of the 218.91. Just going to flip back to the hourly chart for no apparent reason whatsoever. And let's discuss what the ramifications are of today's close. So the 218.91's been on the chart for a while. And if you remember from before, I said, a close above that level could bring into play some of the upper levels that we've identified on the chart from the daily chart. So if I go back to the daily chart, we'll see that before I had other numbers. I had 222, I believe it was 74 off the top of my head. I can't remember, but it's 220. I readjusted the numbers, and I have two potential targets if we should continue higher. 222.04, target number 1, 223.95, target number 2. Now, those are, in the big scheme of things, significantly higher than we are now. In addition, it also supports the case that we're coming out of a bullish sideways consolidation pattern. Could make a case that we had a bearish pattern working for a while from here, right? We had a down move. Okay, so we had this down move. We were going sideways, and the market had an opportunity to break down. It didn't do it. Okay? Now, what happened today? Today, we closed above this red candle high, which is 218.91. That's not the only reason for the significance of that number, but it is significant. And today's close was very important, and to me, it directly brings into play these upper numbers. Now, we're going to put a timing or time frame on this in a second, but let me just make sure that we're all aware that just because the market closed where it did is not a fait accompli that we go higher and complete these other numbers. We've got to have confirmation. And what is confirmation? Confirmation is going to be a close above today's high. A close above today's high, for me, all but solidifies the fact that we're going to go up to 222.04 and 223.95 potentially. Okay, but certainly the first level would be a near-term target. Now, when would this happen? Well, that's, of course, the million-dollar question. And with the million-dollar question comes some analysis and some of the answers that I think will suffice. So let's go through the scenario. First of all, there's a lot of market participants out there, traders, hedge funds. Even the Commitment of Traders report is showing that a lot of the institutional traders or commercials, as they're known, are short the market. Not by a huge margin, but they are positioned for the market to drop. However, the fact that a lot of people have the expectation that the market will fall, generally the market will actually do the opposite of what most people think. That's the contrarian view. But that's not the reason why I believe we have a chance to go higher. Based on today's close, or today's close, I should say, was a bit of a surprise to me. During the day, I thought we would just have more of the same that we had last week, but the last portion of the day, that ramp we had up into the close told me that there's a little bit more buoyancy in this market, bullish behavior in this market, than most people may realize. And if we close above today's high again tomorrow, then I think the game is on for higher prices. Now, today is the 6th of September. September, at least in my work, promises to be somewhat of a wilder month in terms of the market as compared to what we saw over the last month or so. So the dates that I've got that are ultra important, or I should say date, the date that to me is ultra important is out to, I guess it would be considered the 3rd week of September. Or maybe if you count last week as the 1st week, then it's the 4th week. Either way, my date, based on my cycle work, is a culmination on the 19th. Now, that doesn't mean that the market goes up into the 19th or down into the 19th. What that date means to me is that it could very well be a turning point for the market. So if the market is up into that date, plus or minus, maybe that's a Monday, maybe it's the Friday before, maybe it's the Tuesday after. But in that zone, if the market is up into that time frame, specifically to at least the 222.04 or higher number, then I would be looking for a turning point at that point in time. If the market is down into that time frame, conversely, I would be looking for a turning point around that time as well for some kind of a bounce in the market. Now, I can't tell you the magnitude that the market's going to move between now and then. That's the million-dollar question. But what I can tell you is that date, the 19th of September, is extremely, extremely important to my cycle work. So in short, if we stay above this 218.91 level, where we are now, and close above this level of today's high, for example, then I think the game is on for higher prices. Now let's talk about the flip side. So let's go down to the 60-minute chart just to get clarity of where the numbers are. So if we failed up here and we did not close above today's high, and we turn back around tomorrow, then the story remains very much the same as it's been for quite some time, and we have the 217.73 as the most important pivot point, and then 216.97 if the market ended up getting below, staying below, and most importantly confirming below that number. That sends the market into most likely a 100 S&P point sell-off. Not necessarily 100 points from that point, but at least 100 from where we are now. Oh, and by the way, let's just review confirmation one more time. So when the market got down to 216.97, you'll see we never had a close below any day. The low of any day. So for example, the low of this day here was 216.57. Next day we didn't close below. Low here, 216.28. Next day was up. Okay, we tried it again. Okay, down here, next day was up. We tried it again. Now down here we actually did close below. So the low in this candle here was 216.56. But the closing price of the next candle was 216.54, 2 pennies. And you'll know that sometimes when I talk about a close below or a close above, it's got to be, more than a bread box. It's the 2 pennies don't cut it for me. Now, on one hand, I'm saying a close below, and the other hand, I'm saying that's not good enough. You got to take some of this with a grain of salt. A penny or two in the spider and something that trades at $200, $220 a share, 1 or 2 pennies is what I call slippage. So I'm gonna take the mulligan and call that slippage, but you'll see what happened. We put in a long tail candle and the market has been higher ever since that point. Okay, so we'll call that a fake out. We'll call that a false positive. We'll call that nothing ever works 100% of the time. Call it whatever you want. The bottom line is that we're higher now. So I'm looking for, under normal conditions, a close above today's high will, in my opinion, send the market to higher prices. The lower prices remain the same, and that's the story on the spider in a nutshell. All right, let's run through some other stuff. The IWM I thought was interesting today because we didn't have, interestingly enough, the same participation in the IWM that we had in the spider. Okay, the IWM was basically flat all day, finished up 16 cents or just over 0.1%, while the spider was up 0.33%. Not enough of a disparity to make a difference to anything, so we're not going to read anything into it. But I'm obviously keeping my eye on the IWM, and we'll see what happens. If the market's going to run higher, the IWM is going to run higher. If the market's going to pull back, the IWM is going to pull back. It's going to lead the market in one direction or the other. It just doesn't have to do it each and every day. Today, there was a divergence between the spider, albeit a very slight divergence, but a divergence between the spider and the IWM. Another interesting component is the VIX. You'll see here that this is the near-term VIX, and this is the actual CBOE volatility index itself. There's a disparity. The CBOE volatility index, the VIX itself, was up a few pennies today, while the short-term VIX was slightly down today. Neither of them was up or down enough to make a big deal out of it one way or the other. We'll call the VIX flat. The market wasn't tremendously up one way or down one way or the other. So I'm not reading into the VIX, but if the market does continue higher, the VIX will come down in no uncertain terms. Let's go to the transports. The transports has been a pretty good indication for us. We've been talking about it. We've been eyeballing various patterns and various price levels in the transports. And ironically enough, where did we finish today? 79.52.40, slightly above 79.50. You think that number's important? Yes, I do. And the fact that we closed above that number is my first indication that there's bullish behavior in the market, okay? We certainly can't forget about this downsloping trend line that's drawn over from the weekly chart. Let's go over there as a refresher. As you can see here, this purple downsloping trend line represents a potential inverse head and shoulders pattern. You have a left shoulder, you have a head, and then you have a right shoulder. And if you bust through here to the upside, you're going to have a lot of resistance around the 8,200 level. But if, in fact, and I don't believe this to be the case just now, but just technically speaking, if this were to play out to the upside, meaning this head and shoulders pattern, there are significantly, and emphasize significantly, higher prices in store for the transports based on this weekly pattern. I find it hard to believe, yet I have to go with what the technicals say right now. We have not busted through the inverse head and shoulders pattern, but nevertheless, this pattern does exist. Therefore, we discuss it and we have to be aware of it. These are all pieces to the puzzle that get put on the table. As we begin to assemble the puzzle, it gives us the picture of what the likely scenario is in the market going forward that we should expect or can expect. In addition, and this is the weekly chart, remember, this is a bullish pattern that has been developing in the weekly chart. So we had 3 weeks in a row up right into the inverse head and shoulders neckline, and then we've been going sideways, consolidating underneath that neckline for 1, 2, 3, 4, 5, 6, 7, 8. This will be the 9th week. 10 is a very important number in the markets or in anything in our lives. Okay, so next week is the 10th week that we would have been consolidating underneath that head and shoulders neckline. Is next week the week that we bust through? Do we bust through this week? We'll see. It's interesting, but there's in no uncertain terms, this is a bullish pattern consolidating underneath the 79.50 level and the inverse head and shoulders neckline drawn over or drawn on the weekly chart. Going to the daily chart, you can see here, once again, we closed on the 79.50, slightly above it. That's a bullish sign. Today, everything points to bullish behavior in the markets. That's just the way it is. My job is to read and interpret what the market is telling us. I don't necessarily have to have a bias one way or the other. My bias is being correct. I would rather be right in terms of whether the market is going up or down than dig my heels in and say the market should be doing this, and therefore here's all the reasons why it should be doing this despite what's actually happening. That's what a lot of analysts fall into a trap doing. You'll find a lot of strategists and analysts telling you a story about why the market should be doing something, or why a stock should be doing something, or why gold should be doing something, or oil. It doesn't matter. Yet it's doing the other thing, and they find it very, very difficult to change their opinion based on what the market is actually telling them. What I do is I tell you what the market's telling me, and we can make decisions based on the evidence of the pieces of the puzzle that the market is providing us. That's what we do here. If we're going to have higher prices, so be it. I would like to know sooner than later. And in terms of what I'm telling you, I'm trying to provide you the evidence and the areas of where we know these things have the most likely indication of happening or likely outcome of happening. And those are the numbers we discussed in the spider. These are the numbers we're discussing in the transports, all right? So let's go over to gold, which was relatively exciting today. We just never got the complete down move, at least as it stands today, that I was expecting. I wanted to see gold down at that 1297, 1300 level. It didn't happen. What we ended up doing was coming into what's called a midpoint in between these areas. This would be your midpoint, which is simply 50% in between, give or take, the 1318 and the 1297. And we took a ride higher today to a large degree. Gold was up 27.5 bucks, up 2%. It's a big move, okay? We came, the high today was 1357.20. The high of this red candle is 1357.90. Okay, came close. We definitely, obviously, cleared the 50 and the 20 period moving average on a closing basis. We cleared this red candle high, which was at 1344.10, and that puts the market in a bullish position. There is a lot, at least for today, there is a lot of chart congestion in this area here. Okay, that's why we stalled out today. And then there's another important level right here, which is 1371. Okay, that's a little bit of ways away from where we are now, but that's the next major area of resistance that we're going to find in the gold market. So that being the case, let's put a trend line on the chart. 1371 is the number. You'll hear a lot of reasons why gold was up today. Most of them will be linked to the dollar, and we'll talk about the dollar a little bit later and how the dollar got hammered today. But what's interesting is you don't hear the same conversation on days when gold is up big and the dollar is either flat or actually goes up. They dismiss that and give you a different reason why gold is up. So I don't subscribe necessarily to the correlation issue. I recognize that from time to time they do work, or at least they appear to work. However, I just like to analyze each market independent of the other. And for now, we're going to say that gold is in a bullish position. We know that higher prices are coming. I wanted it lower. It didn't happen. We're going to have to just look for an area to get in gold and gold miners, and potentially silver if you so choose. Now, what I will tell you is that if we can see some kind of a sideways consolidation pattern off of this up move, that would be an area that I would be looking to begin getting long gold. It's getting late in the game. Gold's going to make a move, probably at least $75 higher, give or take, between the price we are now and at least to where we wind up in 2016. I've been saying that for months. I've been saying higher prices are coming in 2016, but not before a pullback. If this was all the pullback that's going to happen, so be it. I expected a larger pullback. We didn't get it. The market doesn't necessarily have to do what I expect. It just does what it does. And I didn't get the move that I wanted to get involved in gold down to the 1300 area. Shame on me for not nibbling a little bit sooner. So be it. There's always another trade to be had. Nothing moves in a straight line. We'll look for a pullback, and we'll look to get in on that pullback. Silver, tremendous move today in silver. I'm going to get these fibs off the chart. I mean, you can see here that it was just powering higher. Now, again, with the analysts, they'll tell you the reason why silver outpaced gold is because there's a turnaround in the economy and we see further expansion coming and all systems are go. And as long as the Fed remains accommodative, then we're going to have, a continued lift in the markets and a lift in the economy. And since silver is an industrial metal tied more so to the economic factors or economic indicators than gold is, that's why you see the uplift in silver as compared to gold. Whether or not any of that is true or not, nobody really knows. Silver was up more than gold. That's all you need to know. All the other stuff is just nonsense. The next area of importance for silver is really up in this zone at about 20.5, give or take. You have a pivot high here at 2060. You have a high here at 2056. So in this zone is where you're going to see some resistance for gold, for silver, and gold and silver will most likely find resistance up in that zone relatively close to the same time. We'll see what happens. Didn't get the opportunity in gold or silver. Little bit disappointed. kicking myself a little bit, but that's the business we're in. It's the business of investing / trading. You don't always get the entries you want. Sometimes you miss a trade. There's another one around the corner. Let's go over to crude. Crude actually threatened to have a much larger move than it wind up to have today. It was only up 44 cents or 1%, but you can see here that earlier in the day, we had a high of 46.53, considerably higher than we are now, rejected by the moving averages. In fact, all three moving averages, the 200 period moving averages, the black line, the 50 is the blue line, and the 20 is the red. And you can see here, we busted through all the moving averages and then fell back below all the moving averages. Whoops. And if we're going to see a lift in the major markets, meaning the equity markets, I would have to believe that this is going to wind up to be an ABC corrective pattern or just an ABC pattern. You have an up move, that's A. B is the pullback, and then you would have a culmination of this move finishing at minimum above the high, which was the A leg. Okay, so we'll see if that plays out. If not, if the market, meaning crude oil market, is going to head lower, you're going to have to get below the 44.04. You'll notice that today's low was 43.84. Just from an intraday perspective, let's go take a look what happened when we got down to that level. And this is interesting. So let's do a little bit of a trade lesson on how you handle something like this. Again, this isn't limited to crude oil or this chart. This is a trade lesson for any chart. Remember before, I said 10 is an important number. 10 is an important number in our lives. You can just think about all the things that represent the number 10. We count in tens. 10 is a number that comes up over and over and over again. It's the first double-digit number. There's probably hundreds of reasons why 10 comes up in our daily lives over and over and over again. I can't think of all the reasons why in the heat of the moment making the video, but I'm sure that you can come up with more reasons than I can. The point is that, take my word for it, 10 is important. Okay, if that's the case, and you at least believe that for the purposes of this instruction, that 10 is important, now look what happened here. From this high here, the first red candle is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We had 10 candles down, culminating in a larger candle, which could be viewed as an exhaustion candle, okay, on volume. So you had the highest volume candle throughout this down move on this candle, on the 10th candle. It happened to be trading below an important number, 44.04. Now, when the crude oil market, or this chart, doesn't really matter what it was, didn't close below the 44.04 number on the second candle, meaning the first, when we closed above it on the following candle, that told me that most likely this 44.04 number was going to hold. Then we started to put in a little bit of a bullish pattern, and then you see what happened from that point. And then you see what's happening here is there's another bullish pattern, this 10-minute chart, but another bullish pattern consolidating underneath the 200 period moving average. So likely scenario is we're going to continue higher, at least from a 10-minute chart perspective. But you can see here, 10 candles down into an important number on volume in the last candle. The following candle immediately took back the move below the 44.04, closed above it. That told me there was likely buoyancy or bullish behavior in the crude oil market. So I just wanted to give you a little bit of a flavor and how I look at these charts and how I look at how important numbers converge with time. It's price and time. Time is more important than price. The market is based in price and time. And you can see here by evidence in the crude oil market, at least in the 10-minute chart, that time and price converged and the market just was not ready to go below, stay below, confirm below. We would had to have confirmed below the 44.04 level or below this candle here, which was actually the 920 candle right before the market opened, the pit session opened for the day. And guess what? We didn't confirm below that, and the market took off to the upside. Interesting. If you look at the hourly chart, you can see here's that number. 10 o'clock in the morning, okay, was that candle. Okay, this is the 10 o'clock candle, and the market was persistently up all day. And in the hourly chart, guess what? We closed above the 50 and the 200 period moving average. Couldn't get above here. This is a consolidation point. This is an important level. This was resistance for the market for the day. Okay, and you can see that. That's what happened. Market came into that resistance point, stalled out. That was it for the day. If I was a betting man, higher prices are coming in crude oil. That's what this chart is telling me, at least from a 10-minute chart perspective, hourly chart perspective. And the daily chart's a little suspect based on where we closed today below all the moving averages, but let's see what happens in the following days. By the way, also supportive of time and price, here's your Fib retracement on the hourly chart from recent low to recent high. Here's your 44.04, which is the green line. That's an important number for other reasons. And guess what? When the market broke through that, where did it stop short? The 7.5 retrace was at 43.88. Where was the low of the day? 43.84. Interesting, at least to me. All right, I know this video is getting, and by the way, there's no trade in crude today. You can be long through one of the other vehicles. I wouldn't recommend the futures, but you can be long based on a close below this level here, 43.16. If you want to be long crude oil, you can be long against 43.16 on a daily chart closing basis if you want to see this pattern play out to the upside. If you get a daily close below that level, most likely the market's going down. And hourly closes below 44.04 would be your first indication that that is the case. So let's go over to the bond market. Where's my bond chart? Here it is. Okay. So here's the daily chart, right? So bond market screaming higher today. We obviously were flirting with the 169.25 important level, closed below it on the 2nd. Okay, the close was 169.16, and what happened today? Immediately reversed that. Tremendous up day, closing above the 20-period moving average, not quite reaching the 50 moving average, which is the blue trend line. Now, the bond market being up like this, one might say, well, is this a canary in the coal mine? Higher bond prices, why would stock prices be higher? Isn't that an indication that money is running into the bond market for safety, pushing yields lower, bond prices higher? And wouldn't that mean the equity market is in trouble? Well, under normal conditions, that may well be the case, but they don't have to be on the same day. Okay, I suspect and I submit to you that ultimately the market's going to go down, but as it stands now, our evidence suggests otherwise. So as it is, let's treat every market independent of one another. And I can't help but visually see this for what it is, which is an up move and a long sideways consolidation fighting the 169.25, and this number changes as the contracts roll from one month to another, but this is the important number, and as long as we stay above that number, this market is in a bullish position, no two ways about it. Let's head over to the dollar, and we'll wrap it up. The dollar got hammered today, taken out behind the woodshed and shot twice. Pretty obvious, right? Below all the moving averages, big down day. Generally, a big down day like this signals lower prices coming. It appears to me that this trend line that held already, okay, on down here, okay, this upsloping trend line it appears to me that if we come into this trend line again, it's not going to hold. Okay, then we're going to go down, and the first order of business is we'll test these lows down here, okay, around 94. Then the next order of business is 93, and then the next order of business is 92. It's just give or take. It's just that simple, folks. This stuff is not complex. The market goes in steps, one after the other. If one level doesn't hold, we look to the other. If we go higher, we know our levels on the upside. If we go lower, we know our levels on the downside. And that's the way the market works. It goes from one position to the other. If we know what we're looking at, we can have success in the markets. As it stands for me, I believe the dollar is in trouble right here. A move like this today generally signals lower prices coming. You know, just to depict that. So we had a big down move here, and ultimately the market tried to bounce, but we had lower prices. Big up move, higher prices. Big down move, lower prices. Big down move, lower prices. Big up move, higher prices. Big down move, I think lower prices are coming. And with that, this video is long in the tooth. I'm going to give it a wrap here. I'm David Frost. Get ready for a wild September. Let's try and make some money with it. And by the way, it's not lost on me. I have short positions out there. And if the market does continue higher, those short positions will obviously be in jeopardy. That's not lost on me. I'll address that as the week goes on. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.